Sutherland, and my partner is Kevin O'Grady. Next slide. Thank you. So our agenda, I'm going to go over the major events for this past week, and I'm going to pass it off to Ben, who's going to go over what's happened to the market this past week, as well as movers and shakers and upcoming events to be on the lookout for. So next slide. So the first thing I'm going to talk about is a bill that was passed by the Senate. The bill is going to impact small and medium-sized banks, and it's going to repeal some of the restrictions that's been placed on lenders as a result of the Great Recession. This is all part of Trump's administration's goal to reduce business regulations, and it passed pretty easily in the Senate. Currently, it's in the House right now. They want to add some provisions to it, but despite the setback, it looks like it will become legislation pretty soon. Trump's expected to sign off on it. So that supporters like the bill because they say it's going to spur more lending, which will in turn boost the economy, whereas opponents say it could bring some unnecessary risks. The next thing that we're going to talk about is iHeartMedia files for bankruptcy. And iHeartMedia is the biggest radio broadcaster. Over the past 5 years, they've actually spent more paying out their debt than they have been, or they've been spending more money on debt than they've been earning. So in 2008, they were bought by private equity firms, and since then they've been in a bunch of debt and haven't been able to get out of it. So they're filing for bankruptcy. They're hoping with some restructuring they'll be able to continue operations. And this is interesting because 3 months ago, the second biggest radio broadcaster, which is Cumulus Radio, also filed for bankruptcy. So it's something I wanted to ask the class and see their opinion. Does the outlook for iHeartMedia look good, or does the competition with online streaming of music seem to be too much, and this whole restructuring will have a minimal effect? So I don't know if anyone wants to raise their hand or Ricardo?
Yeah, I read something about iHeartMedia, I think yesterday. It doesn't look too good. I think they're trying to sell off some of their radio stations too, or something like that. So I don't think things are looking too good for them.
Yeah, I actually didn't read that they are going to sell off their radio station, so that's news to me. But yeah, I don't. Just based on the fact that they haven't been earning enough revenue, and then their competitors are also, or not their competitors, but Cumulus Radio is also going bankrupt. It just doesn't look good for radio broadcasters. It seems like online streaming is more popular, but okay. So then the next one, on Sunday, one of Uber's self-driving vehicles killed a pedestrian. So Uber has currently suspended their self-driving program, and the National Transportation Safety Board and the National Highway Traffic Safety Administration are investigating the incident. So I know we talk about in this class how quickly technology is changing, and it's not going to be long before autonomous cars are on the road, but this could be potential for some regulation in this industry, and that could, bump the timeline out. The next is Facebook stocks declines as a result of accusations of user data mishandling by Cambridge Analytica. So Cambridge Analytica helped the Trump campaign in 2016. They're being accused of having mishandled data from Facebook. They are denying claims that they have misused the data, but currently Facebook's also under investigation by the Federal Trade Commission. It's interesting, the stock price fell, I think, 6.8% on Monday, and then another 2.6% yesterday. I think it's increasing now, but I know that Mark Zuckerberg recently made a comment today, and he said that they are going to change their platform to increase data security. So I just wanted to also ask the class what they think about this is with this whole scandal. Do they think that Facebook can come back for it or from it, or if things just aren't looking too good? John?
Excuse me. I guess one of the questions I had about it is, we talked about stakeholders, not shareholders, but stakeholders earlier and it seems to me that that the stakeholders are all of the media, not just the shareholders. And it's kind of an interpretation of, some of the things I've read is that it's been done on both sides of the aisle, and I'm not sure if it's true. I didn't get that deep into it, but I think that it's interesting that it isn't liked in this particular versus maybe, there's a lot of data mining and uses. So I'm wondering if the stakeholders are having a lot to say about what's going on.
Yeah. Anyone else have anything to add? Kyle?
Yeah, I thought something that's interesting in that is as we think about where social media continues to progress forward in time, how important data security is to the success of social media sites, apps, everything involved. And as we start to look at, some of the income statements, balance sheets, how much of data security, how much these companies are investing specifically in data security to protect themselves from potentially being at risk for a major breach.
Yeah, definitely. I also thought this was interesting. I saw in an article that they said that now's the time to buy shares of Facebook if you want to. So just a suggestion. So the next thing is...
Hold on, don't move on yet, Casey. That's a good point. How many of you think this is a good time to buy Facebook? Raise your hand. Okay, we've got a few. Yeah, I mean, it certainly is a downturn for the company if you believe their model is financially strong. Now, they're going to incur some costs here for sure because they're going to have to, I think Zuckerberg announced today he's going to check all these different accounts. So they're going to have some costs attached to this. But if they do it well, and so far they have not handled this crisis well, going back to 2 years ago, if they do it well, they should be able to more than recover. But they've got some work to do. You've probably seen Zuckerberg and Sandberg have both been highly criticized in their handling of all of their external activities, her with the book and him with his world tour, that they've been being criticized for not minding the business or not recognizing just the value of all of this data that they have. Tim, did you have something you wanted to add?
Me? No.
Sorry, Tim. Yep, Tim, we can hear you.
Yeah. No, I'm sorry, you covered it. I was just going to say, the reason I was buying is because the sharp drop in the market, I think eventually will come back. So you already get that.
Okay, thanks. All right,
Okay.
Casey.
All right, so then the next thing is that Congress is working on a funding bill to keep the government funded past Friday because it's currently when the continuing resolution ends. I don't think the government's going to shut down. The House is expected to vote on the bill tomorrow, and then it'll move to the Senate for a vote. Trump's going to get funding for his wall, so it doesn't seem like what's been happening recently is going to happen again on Friday. And then the last thing is...
Hold on, Casey, before you go on, Lauren is our expert on what's going to happen with the government. Lauren, how are you all reacting to this potential shutdown again? Are you thinking it's not going to happen, or are you guys concerned?
So I actually work at Care First, so...
Sorry, I'm getting confused with somebody in my other class. Sorry about that. You're not the right
okay.
Wait, who works for the government and deals with the contracts?
I do.
Oh yeah, Casey. Okay, I do have you completely confused with somebody in my other class. Okay, it's okay, Casey. So tell us what you think. Is it going to happen?
I don't think so. Honestly, I've been looking at this all week, and it does seem like negotiations are progressing. As much as I would like to be furloughed, I don't think it's going to happen.
Fair enough. Okay, thanks.
Yeah, everything I've been reading seems like things are progressing. So,
good.
Yeah. Okay, so then the last thing was that Trump is going to impose tariffs on China. I think more details on the tariffs are supposed to come out tomorrow. We don't know too much yet, except that they're going to be tariffs on imports worth about $30 billion. And this is in response to China's practice of requiring U.S. companies to form joint ventures to do business in China and then transferring their technology to the Chinese partners. So there's some like concern about our intellectual property being like abused over there. So this is in response to that, and China is expected to retaliate. So that's all I have about that. So if you want to go to the next slide, Kevin's going to start talking about the equity markets.
All right. So last Thursday and Friday were relatively quiet. And then on Monday, we had a pretty sharp drop in the market. A lot of people blamed it on the Facebook issues, and other tech stocks were also kind of down, and it kind of dragged the whole market down. So the Dow dropped about 1.4% on Monday. Again, that people kind of attributed that to some of the news about Facebook. And since Monday, though, the Dow has picked up a little bit. It hasn't fully recovered, but it's kind of made up for that dip on Monday. S&P 500 was in a similar situation, dropped also 1.4% on Monday, and it's kind of rebounded since Monday a little bit. The NASDAQ, again, same situation. It dropped a little bit more, though, as the NASDAQ it has a lot of tech stocks in it. It dropped a little more. It dropped about 1.8% on Monday. And then Wilshire 5,000, which I don't know if we've really covered it too much, but it's basically almost all the U.S. companies that stock information is readily available in the U.S. I don't know if it's exactly 5,000, but it's almost everyone. That, again, had similar situation as the other indices I've already talked about. One index that I look at is the Russell 2000. People use that as a benchmark for small cap stocks. This was fairly flat over the course of the last week. They did have a slight drop on Monday, but it was only about 1%, so not as big as the other ones, which makes kind of sense because it's smaller cap companies. People we're worried about the technical, big, large tech companies, and that's kind of what drove the fairly large drop on Monday. If you go to the next slide. Some of the movers and shakers, Boeing was down about 7%, went from $354 last week to $336. The trade policy that Casey mentioned, especially with China, seems like it's worrying a lot of people. Boeing does a lot of business outside of the U.S., and they also had a $37 billion order for planes for China last year. And they projected a $1 trillion worth of aircrafts in China over the next 2 decades. So Casey's story about the potential issues with China has really kind of impacted Boeing. And then to go along with that, Boeing is one of the more expensive components of the Dow. So when Boeing goes down, the Dow tends to also go down. Tesla, we could probably talk about them every week, it seems like, as they're extremely volatile. They were down about 9% this week. Some people started making estimates about their production goals for the first quarter, and they don't think they're going to hit their goals for the Model 3. The Model 3 is their affordable electric luxury car. It's $35,000, and that's really kind of key to the company progressing. At one point, their goal was 5,000 cars per week by the end of fourth quarter 2017, and they've since lowered that a few times. It got lowered to 2,500 cars per week by the end of Q1 2018. So it keeps dropping, and people still don't think they'll hit those goals that they keep lowering. And in addition to that, I used the picture of the Tesla car in space because the shareholders were going to vote, I think it was today, I didn't see the results, on whether to approve a new $2.6 billion stock option for Elon Musk. I think we talked in class a couple of weeks ago about how they kind of structured his pay, because some people are kind of worried about him and his focus, particularly with SpaceX and all.
They approved it today.
Did
It
they?
was, it was approved.
Oh, it was approved. Okay.
Yeah.
So yeah, it was interesting to see that, but people again are more or less concerned about the production and of the Model 3 and how those results are going to come. Alibaba, some people kind of refer to them as kind of like the Amazon of Asia. They had a big charge at the end of last week, moving up from about $191 per share to over $200. They did kind of go down a little bit on Monday as well, but overall they're up about 5%. Some of this was due to some announcements about an investment they were going to make into a company called Lazada Group. It's an Asian e-commerce company. So they had a good week. MuleSoft was up. It skyrocketed this week, up 25% on news that Salesforce might buy them. So they actually stopped trading because it kept going up so high. Snapchat was down 6%. People blame this on a few different things. One was actually kind of tied to the Facebook issues and people being concerned about privacy and data as it relates to the social media. And then there was also other issues with people still don't like the new design of the app. And they also had an issue with an ad about Rihanna and Chris Brown. They had like an ad or like a little game, and it was like there's a little picture over there of it. And Rihanna came out and basically said, delete the app. This ad was wrong, and it was, by all accounts, a ridiculous ad for them to have up. And I just bring that up because a couple weeks ago, I think it was Kylie Jenner. She also like tweeted about how she was like bored with Snapchat, and their market cap fell like $1.3 billion. How much of it was strictly due to her, I don't know, but Snapchat is obviously, a lot of its value is in being kind of cool and people using it. And if these celebrities kind of come out bashing it, it can really kind of, seems like it drives their stock down. Twitter was also down. Again, people kind of blame this on the Facebook news and just the data privacy concerns. I did find it interesting. The reason I kind of put in Snapchat, Twitter, and as well as Facebook is because you would think with the Facebook bad news, potentially its competitors in Snapchat and Twitter might go up, but they were all basically down. I think the concerns for Facebook kind of worried people about Snapchat and Twitter as well. And then lastly, Facebook, Casey kind of mentioned this, the stock was actually down 11%. On Monday, it was the one-day drop of 8% was the biggest drop in 8 years. And in addition to that, Mark Zuckerberg sold about $900 million of stocks, or 4 million shares of stocks since January. So kind of leads me to believe that maybe he knew about this and was kind of dumping some shares. I wanted to go along with that. I wanted to see, and Casey kind of mentioned it too, but does this issue with social media, is it going to change any of your guys' usage on any of them, or is data privacy kind of more of importance now than it was before? Anyone have an opinion on that? John, did you raise your hand, or was it up from before? Or Charles, either one of you?
I feel like now that people are realizing, this is a lot of people not liking Donald Trump. This is the first time that they've had their data used kind of for something they really stand against. So I think that's why they're getting, this big blowback, even though this is, the whole reason Facebook exists is so that it can gather data and then sell it or advertise to you based on that data. So I feel like it's just this, realization more than anything. It's always been going on, but people don't like the end result, basically, is the real big blowback. But I don't think it'll really affect the way people use it because it's so popular, and it's almost an institution now. So
That's an interesting point. I didn't really think about it that way. In that, would people still be upset if it was something that they kind of agreed with? Yeah, it's an interesting point.
yeah, I mean, like the Obama, this kind of built on what John said earlier. The Obama campaign used some of the same tactics, gathering data on massive amounts of people so that they could, target them for political ads, and people, a similar group of people didn't care. But, since a lot of people opposed Trump and he was doing this, suddenly it seems like there's a different view of the tactic. Kind of.
Yeah. All right. So next slide, please. So some upcoming events. There's been a lot of talk about the AT&T and Time Warner potential merger. The Department of Justice has battled the two companies over this. The government typically has challenged horizontal mergers, which combine similar businesses in an industry rather than vertical mergers where businesses within a supply chain merge. So if the Department of Justice wins this, it could threaten the current weave of deals in the drug industry as well. And it also, people were bringing up the deal with Comcast and NBC, which actually happened back in 2011, but there's talk that they might revisit that because when that deal was made, streaming wasn't kind of considered. Comcast was kind of like your cable company, and then NBC was kind of like a TV, but now with streaming, they've kind of more or less become one and the same. So if they were trying to merge now, a lot of people think that wouldn't have been able to go through because of kind of the increase of streaming media. So it'll be interesting to follow that potential merger. Another one that I found interesting was a company, it's called Baidu Inc. People kind of refer to them as the Google of China. They're set to have their IPO for IQI, which is some people kind of refer to as the Netflix of China. This would be the IPO would be in the US, and some of these tech companies' IPOs have really been crazy over the last couple of years. With this being China, obviously has a huge population, and this is one of the bigger companies in China. And then streaming, just as Netflix here has just grown and really boomed over the last 2 years, people are kind of having high hopes for this company and its IPO. Nike earnings are on 3/22. I'd bring that up because of the local ties to Under Armour. It's always kind of good to compare those two, especially living in this area and them being a larger company.
Kyle really likes when you do those comparisons.
Yeah. So Dropbox is going to have an IPO on 3/23. Kind of going back to what I said before, these new tech companies' IPOs have really been taken off over the last few years, and a lot of them have like doubled within a year or two. Dropbox, a lot of people use it, and I think it has a good chance to be a pretty solid company and grow. So
Kevin, I noticed something earlier today, and I didn't pay enough attention to which company it was, but it might have been Dropbox. They're limiting how many shares that they are going to release initially. Did you hear that about Dropbox, or did I look at it about some other?
I didn't see that about Dropbox. When I first looked at this, it was a couple days ago, and it was when they announced the IPO, but they didn't really have a ton of details when I read that. So unfortunately, I don't know if it was that one or not.
I thought it was a company that started with an S, and that off the top of my head, I kept thinking Snapchat, and it's not them. So I'm not sure who it was. I'll look and check it at break.
I think it was Spotify.
Spotify. I knew it was an S company. Thank you. Okay, thanks.
Another local company, McCormick & Company, the earnings are coming out later this week. I had rise of interest rates as a question mark. When I made this slide this morning, it wasn't confirmed, but they did raise interest rates 25 basis points. That came out this afternoon. And then, as I mentioned before, there's rumors of Salesforce acquiring MuleSoft. So we'll see how that kind of goes in the future. And I think that's it. Any questions?
Any questions, or anyone else have other stories that they'd like to talk about? Those were the big ones. The only other one that I think we're hearing a lot about right now is Uber, and with the pedestrian who was injured this week. I think they were starting to recover from all of the issues with the CEO, and now there's some question about them again. So they're experiencing a little bit of stock volatility at the moment. Okay, I think nice job, guys. I think you hit all the big items I wanted to talk about. I'm going to review for the test, and then I've got some questions I need to ask you about something Loyola is thinking about doing and wanted your input on, since you are our test class downtown. And then we'll jump into Chapter 6, and then we'll take a look at Chapter 8. So in terms of the test, overall, I think the scores were pretty good. There was the high score was a 190, which means to whatever score you have on your paper, add 10 points to get a sense for where you are at this point. I always reserve the right to curve more. I never curve less at the end of the semester, so it's possible there's some additional points at this point. If I were concerned about your ability to pass the class, and I think pass the class is anything B- or above, I would have sent you a note. So if you didn't get a note from me at this point, you're still in fine shape. The test overall, as I said, I thought it was pretty good. Let me pull something up to look at while I'm talking to you, so I make sure I hit all the main points. Okay, the first problem was about, I know my notes on your paper are cryptic. That's so when we go over this, you'll know what I was talking about. But yeah, there's not a whole lot of information you see on your paper from me, because I grade so many, and I try to grade one problem at a time as I go through. So given that you send them to me virtually, it's a little bit challenging to the amount of time that it takes to get through them all. So problem number one is companies only growing at 11.2%, but based on the amount of financing, they could grow at 20%. And so what's going on? We had talked about this problem in reverse. What if they're growing at 20% and their sustainable growth rate's only 11.2%? Then they either need more funding, or they need to up their price or create shortages or some way to manage some of that growth. Well, this is the opposite. They're not growing enough. So what you really needed to do is take a look at the formula for sustainable growth rate. And if you remember, it's the ROE and then the retention rate is in there. So what they need to do is they need to cut dividends. ROE, if you think about it in terms of DuPont identity, they need to increase their debt to equity ratio, so borrow more money. They need to improve their profit margin, manage their assets more efficiently. All of those are reasonable choices. Some of you said increase equity. Now, increase equity, so issue new shares of stock in order to have additional funding. That's not right unless you went further than that. So they could have increased equity, but they would also have to increase their debt by more, because their debt to equity ratio has to go up. So if they just increase equity, because equity is in the denominator, that will cause that number to go down and actually worsen their situation. So those are the kinds of things I was looking for on the first one, is really hearkening back to the DuPont identity and how they needed to move any of those factors that go into growth in order to grow their sustainable growth up to the level where they actually can grow. Okay, number two is really about the cash cycle. And if you think about number two, what we have here is 100 days that cash is out and 42 days to collect it. So then we have a 58-day shortage. And so this is really a cash cycle problem. And what I was looking for you to do is tell me that it's essentially we have to finance using working capital that 58 days. And so you could look to manage your inventory more efficiently. You could look to reduce your collection period. You could look to extend your supplier the amount of time before you have to pay. But in essence, what you're looking at in this problem is how to manage that cash cycle to reduce that 58 days down as far as you possibly could. Number three is we have two companies in the same industry. It's funny. I can always tell when I have a class with a good number of accountants in the class, because many of you went right away to depreciation. Maybe they're using different depreciation schedules. You talked about LIFO and FIFO. all of those were just fine. What wasn't okay is to start talking about interest rates and profit margins. Those are all below the EBIT line. So we wanted to look at sales. Maybe one of them was able to premium price. Maybe they were in different markets. Maybe one of them was better at controlling their costs. Those are the kinds of things I was looking for that difference. And this problem was intentional. So 30% to 26% doesn't sound like very much, but if you're talking about a multi-billion-dollar company, those 4 percentage points is actually quite a bit. Number 4, y'all did really well on number 4. I think everybody got the payback correct, which I was impressed. If not, there might have been 1 or 2 errors on payback, but in general, so you have a $20,000 expense, and you're bringing in $5,000 in the first year, $5,000 in the second year, $5,500 in the third year. So by the end of the third year, you've collected $15,500. You need $4,500 of the $5,500 the next year. So that's about 3.82 years. So most of you did really well with that. Some of you took it out to the number of days, which I was very impressed. For the NPV, almost everybody got it right. The only mistake I think people made is they forgot to subtract out the initial outlay. So it was a negative $4,054.43. So it's not a good project. I didn't ask you to tell me if it's a good project or not, but most of you did. IRR is where you ran into some trouble. IRR in this case, remember the cash flows change signs a second time. So they go from negative initially to positive, 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 and then it goes negative in the 5th year. IRR cannot be calculated. So the correct answer is not 0%, which is what you probably got if you calculated it. It doesn't exist. And this is an important problem because we use IRR frequently in the real world. And you want to be able to make the case that, if our cash flows change signs a second time, IRR is gobbledygook. It just doesn't make any sense. Okay, number 5 was also an attempt to give you all of the information that might be thrown at you in really making a decision. So Sue purchased a house for $89,000. That's a sunk cost. She spent $56,000 upgrading it, sunk cost. It's appraised at $212,900. We assume in finance that we're going to be able to sell the house at the appraisal value. And so when we're looking at what the cost is of an asset that we're going to repurpose, we want to look at the highest cost associated with it because we want to be as conservative as possible. So some of you went through and said, well, the house is being rented for $1,200 a month and has maintenance expense and taxes of $4,800, and you actually figured out what this cost is altogether. And that's fine to do, but then you compare it to that $212,000 and you use the highest cost that exists. And so that $212,000 has $20,000 in expenses if you're going to sell it. So the net is $198,200, I think is the correct number. That would be the opportunity cost. That's the amount that she's going to give up if she doesn't sell it and instead converts it to office space. Number 6, yeah, I gave you a lot of leeway on number 6. So the technology industry, what does that look like? For the most part, what I was really looking for is they typically are high beta firms. They typically have high PE ratios. Now, some of you said, well, they have a lot of cash on hand like Apple. Some have cash on hand. Some are really cash poor, that their churn rate is really high. So you had to do more than just say they had a lot of cash on hand, because ordinarily, if I look at a company with a lot of cash on hand, my mind doesn't immediately say, tech company. Some of you said they have a lot of high fixed assets. It's actually exactly the opposite. For tech companies, they typically don't have much in fixed assets. They have more in intangibles. They have patents and they have intellectual property, but not so much fixed assets. I was okay if you said fixed assets if you then went on to explain that you were talking about a company, a tech company that manufactures a lot. But just to say they had a lot of fixed assets, that's generally not true. Ordinarily, they don't have much debt. Ordinarily, they don't have much in the way of interest expense because they don't have much debt. So there were a lot of different possibilities on where you could go here. But saying that all tech companies look like Apple, that's just not right. That's one example within the tech industry, but that's like saying all retail looks like Walmart, and that's not right either because their supply chain is so much better. And then we have the Nordstrom problem. I gave you a lot of leeway here. What I wanted you to do was talk about Nordstrom, and some of you did it beautifully and really really focused on that example we went over in class, that what Nordstrom is doing, remember they have the three cousins who are running the company now, and those cousins are investing. They're investing in tech in order to continue to work online, but they're also growing out. They're doing some of those concept stores where you go in and there's a stylist there, and you might get a manicure as well, and you try on clothes, and they help you accessorize, and you walk out without anything. They're going to ship it to you, so it's not a full store. It's sort of an experience. They're also building out stores. They're upgrading their stores. That was fine to talk about a lot of different things that Nordstrom is doing, but you had to also mention the industry. You had to talk about retail industry in general, and that a lot of it's moving towards more online, and it's highly competitive, and margins are being hurt. So those are the kinds of things I was looking for in terms of Nordstrom, and most of you hit on a good bit of the items in Nordstrom. Any general questions about the test? I'm happy to entertain individual questions separately offline if it's just specific to your test.
Prof, the opportunity cost, can you go over it one more time? I kind of missed that.
The opportunity cost on the house?
Yes.
Okay, so if so we currently could sell that house for 200, and sorry, I just closed it. Is it 212,200? What's the number?
Yeah, 212,900.
Okay, that's the price we could sell it for right now. And if we do, we're going to incur 20,000 in costs. That's an opportunity cost right now. We could sell it. We could continue to rent it, but which is the higher cost? Well, the higher value, which would be a more conservative estimate, the higher cost attached to the office space project would be selling the house. So we really have three choices. We can continue to rent it, we can sell the house, or we can convert it to office space. So if we're going to convert it to office space, the opportunity we give up is the opportunity to sell this house for the 200,000+ less the 20,000 in expenses. That's the next best use for the house because it's the highest price house. So if we're going to go to office space, our initial outlay will include that 198,200, the difference between the selling price less the 20,000 in costs to sell. Do you have that, Janet?
Yep, I got that. Thank you.
Okay. Any other questions about the test? Any questions? No.
One question, sorry. In that, you also talked about the market value, and what specific did we have to talk about the market value for the house? Just that we're gonna sell it? That's about it?
Yeah. So if we don't use office space, we're going to sell the house for the 212,000 less the 20,000 in expenses. That what I was looking for you to do is
Okay.
tell me that that's the difference. That the opportunity cost in converting to office space is we give up the right to net out 198,200 by
Got
selling the house. Okay?
Thank you.
Okay. Anything else on the test? Okay. Overall, I thought you did really well. And I think most people find the final to be a little bit easier. You're more accustomed to the time frame. The final, same thing. It's usually 6 or 7 questions. Sometimes it's only 5 because you typically will do a big capital budgeting problem that takes a little bit longer. So ordinarily, it's the same time frame, about the same number of questions, often one less. And so you're accustomed to that. You're also kind of accustomed to the way that the kinds of ways I ask questions. And so I think most people find the final. And other than chapter 6, if you can do this problem 28, you're golden. But because that's harder than anything I would give you, just because of the time constraint. But you're going to find cost of capital is easy to do. Cost of debt tonight, I think most of you are going to find it's pretty easy. And then cost of equity isn't very challenging either. So a lot of the more difficult concepts are sort of what we're doing right now in chapter 6, and then the rest of it becomes a little bit. I think it's a little bit easier. It's just the components that go into the remainder of the cost of capital. All right, before we go on, I wanted to ask you these questions on behalf of Loyola. So we're looking at a number of different models, and this was the first opportunity to try a class downtown. And we honestly were expecting 5 to 7 students, and fortunately we shut down the enrollment right after break because there were already 20 one of you. And as you can tell, our room did not really accommodate that number. So we've improvised, and you've been very gracious about the improv. Now, Loyola's looking at a couple of things. One thing they're looking at doing is having a cohort program where all of your classes would be downtown. And you could take 2 classes per semester, and you'd finish in 2.5 years. So if Loyola ran a program that was entirely downtown, raise your hand, and raise your hand using the button so I can track it. Raise your hand if you would be interested in a fully all classes downtown program. I can't see any hand raising. Let's see what's going on. Let me see.
I can't raise my hand. I don't know if that's because you
can't
made
raise
me
your hand?
a host and maybe I'm seeing them.
Huh. Well, that's
Oh, I
odd.
can't raise my hand either.
Okay, now I got to figure out. Okay, Ricardo, you raised your hand earlier. How'd you do it? And John, Janet, you're raising your hand. What are you doing to raise it? Is it inside your? Because I see things differently. Is it inside your profile?
Yeah, I'm in the little when you hit participants. It gives you a little everybody's name on the right side, and gives you the option to say yes, no, raise your hand, go slower, go faster.
There you go. Okay, I get the yes, no, go slower, go faster. I don't get the raise your hand. Okay, so if you hit participants, is it at the bottom of your screen?
Yes.
Great. So hit participants at the bottom of your screen and raise your hand if you'd be interested in fully online. 1, 2, 3, 4, 5. Or I'm sorry, fully downtown. Fully downtown. 1, 2, 3, 4, 6, 7, 8. Okay. And another thing that they're considering is having classes downtown, and you'd only have to come downtown if you did this cohort program. You'd only have to come downtown 1 day a week, and what we would do is you would take 2 classes. 1 week, 1 class would be in person, and the other class would be asynchronously online. The opposite week. So if you were taking finance and marketing, and on Tuesday night you'd come to class. 1 week it would be finance, the other week it would be marketing. We'd alternate weeks. And the week that you weren't online, the week that finance wasn't meeting in person, it would be asynchronous. Raise your hand if that appeals to you. Wow, okay. Wow, okay. Now, give me some sense of what you think about those options.
I actually like this where it's asynchronous because then that means I don't have to be there in class always, and especially when I'm traveling, it kind of adjusts. So then I can adjust my traveling schedule with the asynchronous, and I can do it from the hotel too.
Okay. Anybody else on asynchronous?
Yeah, I agree. I feel like typically when I talk to people about the experience in the program, that one of the biggest challenges that I face is that for all of us going through and working an 8 or 9 hour day and going straight from that to just physically being there, I think that sometimes it's not always, the material, but it's just the physically being there for another 2.5 to 3 hours is somewhat draining and maybe not allowing you to get as much out of it if you were at home, kind of in your own comfort zone, just learning the material at your own rate that way.
Yeah, I did my MBA much like you all did. I did it at night after work, and I didn't have kids yet, and I remember how exhausting it was by the end, and how your weekend was really catching up and doing work. Anybody else so in finance, you think you'd be okay, instead of us doing synchronous sessions, you think you'd be okay if we did this asynchronously?
I would say as long as the teacher's kind of readily available for, kind of like you are, you're good at responding, kind of odd hours, and sometimes I think, it would really work that way.
Okay. Well, okay. You all shocked me because I believe you have to learn online because so much of our world is online now. So I do believe in online, but asynchronous is harder for me. And I expected you all would say, oh, no asynchronous, but I'm glad that means you're becoming more independent learners. That's a really good thing. Okay. Any other comments you want to add that I should tell them?
Perfect.
Yeah,
Professor, I was going to say that I really like the videos you post.
Mm-hmm.
If you go, as an asynchronous type of tool, that they help a lot.
Okay, good to know.
One other comment I do want to post, say, just like Anita said, it helps us to prepare and come in your videos, but you also record not only your synchronous and the one in class, you record both of them. So it kind of, even if you miss something, it's easier to go back and review because you have the in-class videos as well as the Zoom videos up there. So it's easier for us to follow through in case if you miss something.
Good. That's helpful. Thanks, Janet. I'm glad you like that. A number of people are uncomfortably being recorded in class, and every so often, if I'm talking about a company, I'll turn off the recording and then turn it back on, just because I don't want to get sued. But in general, I think it's important as a resource as well.
So I would say I like the downtown option or making it asynchronous, but I don't know how I feel about like a cohort. But
I think what they're looking to do is to create a cohort of like 12 people, and then allow other students to take downtown classes up to the capacity of the room. And they're probably looking at that bigger room by our room that they say the technology is not that good. So looking at a bigger room, and so allow maybe another 12 that could come in and out of the class. So you could take some at Timonium, some at Columbia, some downtown. So you'd have the ability to vary campuses if you want to. I think that's what they're sort of talking about right now. Oh, how important is it to you that we are in the Legg Mason building? Is that a plus or a minus? Is parking a plus or a minus? Do you feel safe leaving the coming into and leaving the building? What do you think about that?
I was going to say that's a big plus on my end. I think the more classes there are that are available downtown, when I think about people that are constantly asking questions about which program that they should pursue, with Maryland having stuff that's downtown, with Johns Hopkins downtown, I know that a bunch of people that may live in the city or live closer to the city may be making a decision based on that, or if their workplace is near the city, they may be making their decision off that. So I think the more that we have courses that are available downtown, the more attractive the program will become overall for Loyola as well.
Great.
Yeah, I like the Mason building because it's easier for me to get off of 83 and get on, so it's easier for me to travel. So that kind of really helps.
I was going to say I like the building too, and I feel very safe in the parking garage and everything. However, we last time we just had a hard time. It took a long time to get out of the parking garage, but that was the other times didn't seem quite as bad, but.
Yeah, if I run a few minutes late, we leave at the same time as Hopkins, and they're supposed to have a guard there that lets everybody out quickly. But if that guard is late getting there, it takes a little while. So yeah, I agree with you. They need to manage that a little bit better when we're all exiting. Anything else?
I chose the program because more in-class time in the Columbia campus, and I know they're talking about maybe taking away the Columbia campus. So I'm one of the ones that would much prefer to have it there than downtown. I did this class because it made sense for my schedule, and kind of the downtown was a hindrance to wanting to sign up for this class, basically. But I prefer the in-class stuff. So
I'm kind of with you, Charles. I'm actually exactly kind of the same. But I kind of like this class. It was something different. But I'm just partial to Columbia. I'm spoiled. I happen to live and work not far, so, and I do like the in-person. I always said I did, but honestly, this synchronistic, I guess, and the the variety of in person and that I'm enjoying it. It's not so bad.
Okay. That's a glowing testament. It's not so bad. Corey, just to correct that. In fact, it was my perception as well that we were going to close Columbia. We're not. We're going to run it we're going to continue at Timonium and Columbia, and now they're looking at downtown as a third option. But there's no intent. We may shrink our footprint there. Not all programs might be in Columbia, but the MBA is going to continue in Columbia, so that they're not shifting that.
Can I ask a question? I think you said about the cohort. Does that mean if you have to come to downtown, you have to take 2 classes because with kids and work, I can't take 2 classes. I tried that last semester. It was hell for me.
Yeah, yeah. Cohorts are tough because, you know, if you've got busy season and those kinds of things, cohorts can be really tough. People get married and, you know, they're going to be gone for 2 weeks and missing 2 classes for 2 weeks. That's a problem. No, what they're looking to do is have a small cohort of maybe 12 that would take all of their classes together, but have capacity for 20 plus. And so there would always be slots for people to come take classes downtown and not be part of the cohort, so that you would have the ability to move in and out. You just have to make sure you sign up for class early, you know, once registration opens up. But their ideal is to have about 30 students, 12 being in the cohort, and then like 18 seats left for other people who want to be downtown but don't want to be part of the cohort.
Okay, that sounds fair.
Done in 2.5 years, you know, with your travel schedules with kids, and there's a lot of people that 2 classes a semester, every semester is really hard.
I think it's a good idea.
The cohort or downtown?
The cohort with the ability for other folks to join in. I think it would work well.
Okay, good. Excellent. Well, you guys were really helpful. They're going to appreciate that feedback. And I told them what I thought you were going to say, and you proved me completely wrong on the asynchronous. And now I'm going to have to rethink. I always think I'm penalizing you all when I do anything asynchronous, and now I'm going to have to rethink that. So thanks for setting me straight as well. Okay.
Bruce.
Yeah, go ahead, Bruce.
Yeah, I'm kind of with Corey. I picked this class because of, well, one, I like to be in person, but I also travel a lot for work, so I like the ability to go online and I actually looked at the dates before, and I knew I was going to travel for 3 of the days that were online, and it worked out really well.
Good. The one thing, like for next week, I'm going to give you the option of being in person or being online. The only reason I don't do that every week is I find it really difficult to manage discussion with the class in person when somebody from online is trying to ask questions as well. It just gets a little bit messy, but it's probably something I need to think about figuring out how to do better so that you have that option pretty much every week of being online synchronously or not. And I think you guys just assured that I'm going to spend some time this summer making some things asynchronous, because Loyola would like me to do that too. So.
Yeah, for next week, my vote is to make it online, and because I'm out traveling next week, so I would appreciate that.
Yeah. So now that I only needed 1 Janet. So as long as we have at least 1 person who wants to be online, I'll be in Lake Mason, but we will be both Zoom enabled as well as in person. So take your pick, and I don't care which you pick. All right. Excellent. Thanks. Now we did finish problem 20 last time, right? I was only going to do problem 28. Is that correct? That's what I was remembering anyway.
No, we did 20 and 28.
I need to do 20 as well? Sorry, forgot about that one. Thanks. Okay, problem 20. Now let me go find it. Oh, yeah. Problem 20 is we're going to buy a new piece of equipment, and it's going to cost $415,000. It's going to work for 5 years. And at the end of the 5 years, it's going to be fully depreciated. But we believe that the market value of the machine at that point is going to be $50,000. So we fully depreciate it, but there's some value that we expect to achieve, and so we're going to have to take that into consideration, tax implications of that. They're not telling us revenues, less costs. They're just going to say we're going to be able to remove a few people, and we're going to save $120,000 in salaries. Now, the difference on this one is when we undertake this project, we're going to cut our working capital initially. Anything that changes with working capital, when the project is over 5 years later, we have to reverse. So if we're cutting our working capital initially, we're going to need to replace that working capital at the end. Tax rate is 34% and required return is 9%. All right, anybody want to tell me how they did on number 20 or what they came up with for a value? I'll just start jumping in there and dying to answer. Brian, you want to tell me an answer? You're muted. There you go.
Sure, I'll tell you an answer.
Okay.
I got 52, 279, 56.
52, 279, 96. I think you did
56.
darn well. That was awfully good. Okay, so what do we have? Our initial outlay is the $415,000.
What kind of use?
Oh, you did. Good. I'd say you used it really well. So the initial outlay is $415,000, but we're going to save. So that's an outflow, a cash outflow, but that savings and working capital is going to be a cash inflow of $80,000. So our total initial outlay is $335,000. This problem is nice in that we have the same cash flows every year. That's not real world. Number 28 is much more real world, but we're assuming we're going to save $120,000 each year for 5 years. Depreciation will be the cost of the investment, $415,000 divided by 5, since it's straight line. So we're going to have $83,000 in depreciation each year. This is an earnings before taxes of $37,000. Given our tax rate of 35%, our net income is $24,420. Diana, how did I get this operating cash flow? Turn your mic on. There you go.
Sorry. Getting everything back on. So with your operating cash flow, you took your initial investment of the $415,000. You took out the net working capital. That was $335K. Then you also took into consideration your incremental cash flow of the $120K plus your depreciation of the $83K. So you had your earnings before taxes of $37K, less your taxes of the $12K. Your net income was the $24,000, and then you ended up with your operating cash flow of the $107,000.
How did I get that $107,000?
So that was your depreciation, your depreciation plus your net income.
Plus EBIT.
Yeah.
EBIT plus depreciation minus taxes.
Right.
Okay, so it's this $37,000 plus $83,000 minus $12,580. That's how I get that $107,000. And then at the end of the life of the project, we're going to have this salvage value. So we've fully depreciated the asset down to zero. We have a sales. We're going to get $50,000. We're expecting to get $50,000. We need to pay taxes of 35% on that. So our after-tax salvage value is $33,000. So here's what my cash flow stream is going to look like. Cash outflow of $335,000 initially, inflow of the operating cash flows for years 1 through 4, and then in year 5 we have that $107,000, but we have to subtract. We add to it the salvage value of $33,000, but then we have to subtract out that working capital, because the working capital that we were able to save initially, we have to replace at the end of the life. So we have to add that back to get to the $60,000. And I compute an NPV, and I get an NPV of $52,279. Kyle, is this a good project?
It depends.
On?
If the company is expecting to see an IRR greater than 15%, if that's good for the industry.
Okay, so let's see. The discount rate for this project is 9%. So is this a good project?
Yeah.
Yeah, it's a positive NPV. It's earning above the required rate of return for projects at this level of risk. So it should be a good project. You almost never do an NPV in isolation. So you typically do some scenarios. What if our salary savings were only $110,000? Is it still a good project? What if the salvage value at the end isn't $50,000, it's only $10,000? Is it a good project? So you'll run several scenarios just to make sure that number is robust and you maintain a positive NPV. But at this point, it looks like a pretty good project. Any questions on number 20? Okay, let's take a look at number 28. All right, 28 is a whopper of a project. It's the most realistic problem that we've done so far. So what do we have? We're going to have sales for 5 years, and look what happens to sales. This is not uncommon. They go up for 3 years, and then they begin to decline. We're going to spend $1,500 initially in working capital. But our working capital needs are going to be 15% of incremental sales each year from here on out. And this is really common. As sales grow, we have to grow our inventories, we grow our accounts receivable. As sales begin to decline, we reduce our working capital. So we're going to have some years where we're where net working capital are going to be outflows, and other years where it's going to be an inflow. And at the end of the life, we sum together all of that working capital and reverse out of what we've done. The fixed costs are $1.85 million. Variable costs are $190 per unit, with the price for each unit $345. The equipment's going to cost $19,500,000 up front. And of course, it's an accelerated depreciation, so everything gets complex. The salvage value we expect to be 20% of the price of the equipment. So we pay $19,500 for the equipment. 20% of that's going to be our salvage at the end. 35% tax rate and an 18% rate of return. Anytime we would do an accelerated depreciation, I would have to give this to you. So here's the depreciation schedule. Okay, all right. Michelle, where do you start with this problem? What are you going to do?
Well, the first thing I did was to compute the sales units times the per unit sale price, came up with that unit amount, the total sales amount. And then I also figured out the depreciation amounts.
Good. Okay. That's a biggie. All right. So what Michelle is doing is she's setting up pro forma income statements first. And so she did two things. So let's start with the easier of the two that she did. You guys over here. The easier is she set up the pro forma. And so she started by looking at what are the sales each year. So she looked at the units sold times the price of $345. So the first year we're selling 81,000 units times a price of $345. So we have sales in year one of $16,713,000. I'm sorry, we have sales in year one of $27,945,000. He then goes through and subtracts the variable costs, are $190 per unit. The fixed costs are the same each period, and then we need depreciation. Well, let's start with just what that depreciation number is going to be. So initially, the price of our equipment is $19,500,000. Depreciation in the first year is 14.29%. If you've got your mic on, would you please turn it off? Thanks. Thank you. So it's 14.29% in the first year. So our depreciation in the first year is 2.786 to get to our EBIT. Our taxes are 35% to get to our net income. Okay, so just there, we do that exact same thing for each of the 5 years. The only thing that changes is our sales numbers are going to change because we sell different number of units. That's also going to cause our variable cost to change each time. And then our depreciation figures change each time based on the accelerated depreciation schedule. So to get to here, line 41 with net income, what questions do you have? Betty, everybody good on how we got to those net income numbers?
Can you go, how do you do the changing depreciation schedule? How was that calculated? Sorry.
Okay, so the depreciation schedule is right here. We have equipment of $19.5 million. In the first year, the depreciation is 14.29% of that. The next year, the depreciation is almost 25% of it. The next year, it's 17%, and so on. So for the first year depreciation, we take 14.29% times 19.5 million, and that's going to give us this 2.786 million. Does that make sense?
Yeah.
Okay.
Thanks.
Okay. So we're still on this net income number right here. What other questions do you have on anything that got us to that point?
The variable cost, you basically took the price at 190 and you did it by the you multiply that by the sales, right?
By the number of units that you're selling each time.
Okay.
Yeah.
Cool.
Janet, I'm glad you asked that. I always forget you're one of the few that haven't had an accounting class. And I've got to be more aware of that students coming in now don't have to have that accounting class. So the variable cost is 190 times the number of units each year.
Yep, sounds good.
Okay. What else up until that net income number is confusing? Good. Okay. At that point, we have to figure out the operating cash flow. And operating cash flow is just your EBIT, the 7.9 million, plus depreciation of 2.78 million minus taxes of 2.7 million, and that gets us this line 43 for our operating cash flow. In fact, let me write that over here so you don't forget. And that's huge because at this point now, we have all of the operating cash flows for all 5 years. And that's a biggie. Okay, now let's look at our initial outflows.
Do you have a preference from just going that kind of top-down approach versus the bottom-up instead of just taking net income plus depreciation? Is it because of interest or?
Yeah, you can do net income plus depreciation, which is what I did in this example. The only reason I hesitate on that is sometimes people look at the pro formas going out that were created for other purposes and interest expenses being factored in there, and so then you're going to get the incorrect answer. So the only reason I teach the EBIT plus depreciation minus taxes is just to remind you that is just so you don't have to keep straight if you're looking at a pro forma that has interest expense in there. But for our purposes in this class, we're always going to use pro formas that do not include an interest expense, so you can do the bottom up just as easily.
Okay.
Okay.
Carol, don't we have to do that income statement to figure out the right tax number? Like, for example, in this one?
To figure out the tax number?
To get the value for taxes.
The value for taxes is the 35% tax rate times EBIT.
Right, but to create the right EBIT, to do that, to multiply the 0.35 times, you have to build that up first, right?
Gosh, you're really, it's really hard to hear you. Are you on a microphone?
Yeah.
Try unplugging and see if I can hear you better.
I was going to say, I kind of understand what he's saying. I think he's saying we think we need to go to calculate all that to get the calculate the taxes correctly.
Yeah. Okay. Okay. You guys are accountants again. You're right. If we were doing this for purposes of really seeing what the pro forma is, we would have to take out interest expense because that affects our taxable income. But remember, when we're doing this from a financial standpoint, we want to be conservative. And so not taking into consideration the tax advantage of interest is okay. What we'll see in a couple of chapters from now, we take that tax consideration into effect when we do the cost of capital later on. So we capture that another way, but we typically do not include interest expense into a pro forma when we're trying to do a capital budgeting problem. We allow taxes to be higher to be a little bit more conservative. So many things are overestimated and are overly optimistic in a pro forma anyway. You know, we're going to get a higher price than we thought, we're going to sell more units, and so we tend to be a little bit more conservative on the taxes. But from an accounting standpoint, in terms of planning purposes, Anita, you are absolutely correct that you ordinarily would take out interest expense before calculating your taxes, but not in a capital budgeting framework. Did I answer your question? I think so. Okay. Okay. So we have our operating cash flow. We've got this line 43. So now we need to go back and look at our initial outlay. So initially, what did we spend money on? Joshua, what did we spend money on?
Spend money on buying the machine while getting the net working capital to purchase them, produce the implants, I should say, not make the machine.
Beautiful. Okay, so we spent 19.5 in buying this machine, and then we had to invest in working capital initially of 1.5 million. So you just did line 0. So our initial outlay is $21 million. Everybody good on how we came up with that number?
Could you repeat that, please?
Yes. So initially, what we had to do is we had to do two things. We had to buy the piece of equipment, and it cost us $19.5 million. And we also had to start by investing in some working capital. We had to invest in some inventory. We had to extend some credit. And so that cost us $1.5 million up front. So our total outflow to start this project is $21 million. Good?
Good.
Okay, good. Okay, so now you have this number. You have all of line 46. Now let's look at working capital. So we started with 1.5 million in working capital. And now we need to look at the difference in our sales numbers. So we had 81,000 units in year 1, and we had 89,000 in year 2. our working capital has to be at 15% of sales. So we had an additional 8,000 units of sales, and so we have to take into consideration the fact that we have an additional 8,000 in sales, and so we have to add in that difference in terms of working capital. We have 8,000, and our working capital is 15% of sales. So 15% of that difference is how much we're going to need in terms of working capital each year. Okay, so that's how we get these numbers right here. Sorry, pop that out. And what you'll notice is that we had to build up working capital for the first 2 years, because between years 1 and 2, our sales increased by $8,000. Between year 2 and 3, it increased by another $8,000. But between year 3 and 4, it declined by $5,000. So we're actually going to recover some working capital. So whereas we're investing in working capital in year 1 and investing in working capital in year 2, in year 3, we're starting to recover some. In year 4, we recover a little bit more. And then in year 5, we just sum all of those working capitals together to see how much we recover all together. So initially, we invested $1.5 million in working capital. Because our working capital grew by 8,000 units in year 1, we had to invest another $414,000. In year 2, it increased by another 8,000, so we had to invest another $414,000. In year 3, it declined by 5,000, so we recouped $258,000. In year 4, we recouped $776,000. And in the final working capital number is just the sum of all of these numbers. So we spent, recovered a little bit, and then in the last year, we recover all of our working capital that we've expended thus far. Janet, tell me what questions you have on that one. That's a real accounting number. So
I'm still processing.
Okay.
I have a question.
Yes.
So like the 414 that's under year 1, when I first did the problem, I put that under year 2 because we were doing the difference. And did we move it back to 1 because it says the problem says follows?
Yes.
Or is it, okay, it's specifically the word follows, or otherwise I would have put it under 2?
Yeah, we ordinarily assume we invest at the beginning of the year, and so we invest it because our sales were going to grow by 8,000. We had to invest in it at the beginning of the year to use it all year long.
Okay, and then the second question is, the problem didn't specify that at the end we were going to recoup 100% of that. Do we always just assume that's the case?
Yeah, for our purposes in this class, Michelle, always assume that we recover it at market value, so we recoup it all. In the real world, if you're working at your company and they're assuming that you're going to get 80% of it back, you would just make that adjustment. But in 703, we always assume that you recoup the full market value.
Okay, thank you.
And this is one of the hardest parts of this problem. Any other questions about those working capital numbers? How we came up with any of them? Okay, the only other challenging part, and this is a good challenge, is our capital spending. So we spent $19.5 million initially, and we see in the problem that we believe we're going to be able to sell it at the end of the life for, I think it's like $3.9 million. Way too much junk is popping up on here. We're going to be able to sell it for $3.9 million. Okay, so what we need to do is see what it's worth on the books at the end of the life. So we need to pay attention to that depreciation schedule. So I worked through it. So initially the asset sold for $19.5 million. Depreciation the first year was $2.786 million, and that's the same number we have right here. Okay, so we have that number in our program. So with a $19.5 million investment, at the end of the first year when we depreciate it by $2.7 million, our asset is worth $16.7 million. The next year, we depreciate $4.7 million. So we take that $4.7 million from the depreciated value of the asset. So at the end of the second year, the asset's worth $11.9 million. In the third year, we depreciate it by $3.4 million more. So it's worth $8.5 million. The next year, we depreciate it by $2.4 million, so it's worth $6.09 million. And the final year, we have depreciation of $1.7 million. So on our books, it's worth $4.35 million. Okay. tell me what questions you have about that process, figuring out the book value of the asset. Everybody okay on that? Okay, here's our dilemma. We can sell the asset for $3.9 million. It's on our books for $4.35 million. What does that mean? What do we need to do? Anybody?
I have a question.
Yeah.
Well, why wouldn't you fully depreciate it? If you've got a 7-year schedule, but you're only going to have it for 5.
You're not allowed to accelerate it any more quickly.
Okay. Oh, okay. So the other 2 years would account for that last 4.
Exactly.
Yes, I got you.
If this project would continue on for another 2 years, it would be fully depreciated. But we're only looking at it as a 5-year project, so it's still going to have depreciable value at the end of 5 years. And in fact, it's got value of $4.35 million, but we only think it's going to be worth $3.9 million. So now what?
But playing devil's advocate in the real world, can you say it's a 5-year project and it's over, and I'm going to do a straight line depreciation and not do the 7-year MACRS?
That's a question for Anita or Michelle or Cindy. They're better at taxes and accounting processes than I am, but I don't think you would want a straight line depreciated over 5 years. Yeah, that would be 20% per year. Anita, can you do that? Because it actually benefits you the first year, hurts you a little bit in the second year.
Yes.
Can you go ahead and depreciate it straight line for 5 years?
I'm thinking if the but you have to know the useful life, right? I think. And if that's 7 years, you can't.
I think you have to go by whatever type of bucket the equipment is, according to the IRS, which in this case is the 7 makers.
That makes sense. That makes a lot of sense. Hold on a second. I've got. Okay. Okay. Yeah, I think you're right. I think the type of equipment requires a particular type of depreciation schedule. Is that your understanding, Michelle?
That's always been my understanding. I mean, someone else might think otherwise. I mean, might be able to correct me, but that is my understanding.
Yeah, I'm thinking about technology, and there's a schedule for technology, and you have to depreciate it a particular way. John, I don't think you can manipulate it that way. I think equipment falls in particular categories, and you have to depreciate it on a given schedule, given the category that it falls into. I'm quite positive that's right. And Michelle, thank you. I think you're exactly right.
So to answer your question, evidently it has a book value of about $450,000 more than what we can salvage it for.
Right.
So you take, I'm trying to think of what you do with it. Not completely sure. I need some help.
Anybody else?
Do we have to take taxes out?
Do you have to take taxes out? It's a tax issue, but do you take taxes out?
Do you get a credit?
I guess you have to pay the taxes.
You actually get a tax credit because in this case, you're only going to sell it for $3.9 million. It's on your books for more, so you're actually going to get a tax credit. So what we're going to get is, as John said, we have $450,000 of value on the books that we're not going to realize. So we get a tax credit of the $157,000, 35% of that $450,000. So our recovery at the end of the life of this asset is the $3.9 million plus the $157,000 in tax credit for a total of $4 million, just over $4 million. So that's where that number came from. So then you sum together all of your cash flows. We had, scoot this over a little bit so you can see better. We had $21 million in initial outlay. We have positive cash flows for the first 4 years that included the operating cash flow and the working capital changes. And then in the last year, we have our operating cash flow the recovery of all of our working capital, and then the sale and tax credit to get the number in year 5. And when you calculate the NPV at an 18% required rate, we end up with an NPV of 8.4 million. And in fact, when we calculate the IRR, it's 33%. So we require 18%. We're actually looking to earn 33%. So this is a good project. This is as close to real world as anything that we do in here. And it's a good, challenging problem because your working capital changes every year. You get a tax credit, which is really unusual. And then you have your operating cash flows that are based on changing sales each year and a modified accelerated depreciation schedule. So all of that adds complexity. But this is a really good problem. It's similar to the Baldwin one in the book. So looking back through the Baldwin should help you with this problem, but it's worth taking another look at this problem. What questions do you have about this one? John R.
Does the company have the option to like defer the tax credit?
Ordinarily, you do. They don't have to take it this period of time, but why would you defer it?
To change your earnings in the future? Or?
Yeah, and they could still do that, but for the purposes of this project, it's a relevant cash flow for this project. Just because they recognize in deciding if they go forward with this project that there's a tax credit doesn't require them to take the tax credit. This is for planning purposes, and for planning purposes, we want to be conservative, but we want to be holistically considering all cash flows, both positive and negative. So the tax credit that's associated with the sale of this equipment is relevant to this project, so it has to be included. It does not mean the company has to take it at that point in time. They could push it out further if they wanted to. What other question? Yeah.
I had a question. I always get confused which, when you're calculating taxes, I guess I was using the tax shield approach, what numbers you multiply by the tax rate and what numbers you multiply by 1 minus the tax rate.
Oh, okay.
I always come down to that too and get confused.
That's a good question. So when you're in a pro forma financial statement and you've got EBIT, you multiply that times the tax rate to get the taxes that year, and then subtract those taxes from EBIT to get to your net income. When we're doing this cash flow problem, we have an asset that we're going to sell for $3.9 million. It's worth over $4 million, so the taxable income is $450,000. We calculate the taxes by multiplying it by 35%. That would get us, and then we subtract those taxes in order to get the after-tax value. So if we're trying to figure out how much cash we're going to receive or have to pay, it's the taxable income times 1 minus tax rate. Government gets the taxable income, we get the rest. If we're trying to figure out in a pro forma income statement how much tax we have to pay, you're just using the 35%. When we get to the bonds in the next chapter, we take the bond rate times 1 minus the tax rate. What the 1 minus tax rate does is it tells us we give the taxes to the government. We care about what the cash flows are to us, and the 1 minus tax rate gets to what our cash flows are going to be, what we're going to receive. Does that make sense? Good.
Carol, I have one more question.
Sure, John.
When I went through and I've done the MPV correctly. On the calculator, when you want to have the IRR next, what are the moves you do on the calculator?
Okay, you did the NPV, then just hit the IRR button and hit compute.
Beautiful. Thank
Got
you.
it?
Yep.
Yeah, IRR, once you've done the NPV, IRR is a piece of cake.
Good deal. Thank you.
Okay. Everybody good on problem 28? Or at least follows problem 28. It's okay if you couldn't sit down and do this problem on your own at this moment, but if you can follow it, that's important.
Sorry, just one more question. The change in net working capital year by year, you're just taking the change in sales times the rate.
Yes. So we're going to take the change in sales from of first year's 8,000 units times $345. That number times a 15%, and that's going to be our additional working capital. You could also come down here and say, okay, sales were 27.9 million in year one. They're 30.7 million in year two. That difference times the 15%, and that will get you to your additional working capital needs.
Got it.
Okay. What else on this problem? Okay, that's a good place. After a problem like that, it's a great time to breathe. So this is a good spot to take a quick break. Let's come back at 5 after 8, and then we will be ready to jump into chapter 8 at that point in time. And we'll get a good bit of the way through chapter 8. Okay, see you in a few minutes. Chapter 8 is what I consider a breather chapter. After everything we went through in chapter 6, we finish up that big problem, and chapter 8 is absolutely nothing new. Other than a little bit of language around bonds, you know everything in this chapter already. It's just applied to a different type of asset. So hopefully you're going to really love chapter 8. So with a bond, typically bonds debt for a company. They typically sell for $1,000 face value, and then they have a coupon rate attached to them. So a common bond pays interest payments every 6 months. For ordinarily bonds are 20-year bonds when they're issued initially. They pay interest every 6 months, and then at the end of the life of the bond, you get your $1,000 back. Those interest payments they pay every 6 months are called coupon payments. And it's because back in the day, it used to be when you got a bond, came with a coupon book, and every 6 months you'd go into the bank and you'd tear off one of those coupons and you'd hand it to them, and they'd hand you your interest payments. Now, interest rates move in the opposite direction as the value of the bond. So the present value of the bond, when interest rates go up, the present value of the bonds go down. And that's why we typically see stock markets and bond markets move in the opposite direction. Typically, not always true, but typically. Okay, so here's an example where we have a government bond that has a 6 3/8% coupon rate that expires in December of 2020. It was sold initially for $1,000. It's coupon payments semi-annual, most common. So if it's a 6 3/8% bond, that means 6 3/8% of $1,000, or $63.75 every year in interest payments. Half of that every 6 months. So if your coupon rate is 8%, that means you're getting $80 per year, but you're actually getting $40 every 6 months. That's an important cash flow. Now it's the exact same amount every period, so that's a payment. And then at the last year of the bond, you also get your $1,000 back. So in this particular bond, we're assuming it's January 1st of 2016. So bonds are typically issued for 20 years, but at this point, 15 years have expired. So we're sitting here at January 1st of 2016. The bond has 5 years left in its life before it expires in 2020. So the cash flows would be $31.87 every 6 months, and in the last year of the project, you get your $31.87 plus you get your $1,000 back. We can value this. This is just figuring out a present value. We have payments of $31,875. We have a future value of $1,000, and we know it's 5 years or 10 payments that are going to occur through time. So we could figure out what the present value of this is if we knew what the interest rate was. And in bonds, the interest rate we call a yield to maturity, or a yield. So in this case, the yield is 5%. Well, there's the formula, but let's talk about it the way we do it. So we have a bond with 5 years left in its life, or 10 coupon payments over the course of the life. The yield to maturity is 5%. That's the interest rate. So we cut that in half because we're going to get half of that yield every 6 months. The payment amount we already figured out is $31,875, and the future value is $1,000. Now here's where those signs become really important, because you're going to buy a bond and then you're going to receive positive cash flows of payments and positive cash flows of a future value. So the payment and future value in the bonds have got to be positive, and the present value has to be a negative number. Otherwise, your calculator will blow up really quickly. So if you compute this value, you're going to end up with 1,060.17. And I knew ahead of time that this bond was going to be worth more than $1,000. The reason I knew that is my coupon rate is 6 3/8%, and the yield on current bonds is 5%. Bonds of equal risk level that should pay the same rate when they're issued. Over time, interest rates move. We saw the Fed raised interest rates today. With a bond, you lock in at a particular rate, so your coupon rate is locked over the course of those the 20 years that you own the bond. The yields, though, move as the Fed moves interest rates. So when your coupon is 6 3/8 and current bonds of the same risk are only earning 5%, people will pay you more for your bond because they're going to get more in coupon payments. So when the coupon rate is above the yield, a bond is selling at a premium. It's selling above $1,000. On the other hand, if you've locked in at 6 3/8% and the yield on current bonds is now 8%, that means other people are getting $80 a year. You're only getting $63 a year. So that bond is going to sell at a discount, something below $1,000. That logic becomes really helpful as time goes on because it allows you to sort of check to see if your numbers make sense. Now, what if the yield was actually 11%? Does that change the bond's price? Absolutely it does. You've locked in at 6 3/8%. Bonds of equal risk are now getting 11%. And so the bonds that are getting 11%, those bondholders are not going to pay you $1,000 if they wanted to buy your bond. They're going to pay you something less than that. And in fact, they'd be paying you $825.69. Now, on the spreadsheet, if you have the data analytics pack loaded on Excel, you can use these formulas to do the calculation. If you have to load the data analytics, and if you look at Excel, it shows you how to add the tool packs, and so that's the analytics tool pack. Here's the formulas to figure out the price of the bond or the present value or the yield for the bond. I'll show you how to use these formulas a few times over the course of tonight. But you never have to touch those formulas. You can use the standard present value formula that we used before, and you can use the standard rate formula. So if you don't have a desire to learn a new formula, if you don't plan to be a bond trader, you don't need to learn a new formula. So I showed you the formulas. You've now seen them. You can use them if you so desire, but you don't have to. You can use the present value formula and the rate formula, and we're going to do that right now. So what I'd like you to do is I'm going to put you in breakout rooms. And I want you to, let's just do problem 2 first. So take a look at problem 2, and it wants you to figure out the price of the bond 3 different ways. If the yield to maturity is 7%, if it's 9%, and if it's 5%. So you're going to be calculating 3 different prices for the bond. And take a few minutes. Once you have done those calculations, you can use either Excel or your calculators, whichever you prefer. Come on back in here once you're done, and we'll take a look at your results. Let's see how many people we have. We'll put a good number of rooms out there. Okay.
Sorry, which problem again?
It's problem number 2 at the end of the chapter. It's on page 267, and it's called Valuing Bonds. Okay, your room should be open, and have at it. Good luck. Now, let's see, everybody should be back in here now. Looks like everybody's back. Okay. Well, Kyle, since you were first back in the room, go ahead. How'd you approach this problem? Let's do part A.
Okay. Yep. So for the 7%, I went into Excel and basically just set up future value, which here in this case I put 1,000 for the par value listed. The end number of payments was 40, since this was 20 years for maturity. I'm assuming the semi-annual payments. as it's listed there. So 20 times 2. The payment is at 35, so that would be taking the coupon rate of 7% times 1,000, which is 70, divided by 2 is 35, and then the rate is the 7% divided by 2 because of the semi-annual payments.
Okay.
And then when putting into Excel equals PV and putting in those inputs appropriately, it came out to 1,000.
Yeah. Okay, so in Part A, you've got a 7% coupon bond, and the yield to maturity on this other bond is 7%, means it's selling at par. So the present value of that bond would be $1,000. Everybody okay with Part A? How we came up with that? Okay, Part B, we've got a yield of 9%. Does that mean the bond is selling at a discount or a premium? Corey? Our bond has a 7% coupon and the yield is 9%. Is that a discount or a premium? Corey, your mic's off.
Yes, it's selling at a discount because you can get because the coupon rate's below what the going rate is, so you would have to pay. It would sell for less because people would rather the going rate than this particular bond.
Exactly. John R., did you have a question, or do you know the answer for Part B? I think your mic is still off, John.
Oh, yeah, Part B, I had 815.98. I was just gonna say that too. Yeah, that it was a discount.
Good, good. So for Part B, it's selling at a discount, and the price, given the yield is 9%, you would put in. Given the yield is 9%, you're going to put in your payment is still 35, and your yield to maturity, instead of being 3.5% in this problem, it's going to be 4.5%. And then you calculate your price, and you should have gotten 815.98. And then in the last one, the yield of 5%, that means you're going to put in 2.5% and come up with a price of 12.51. That last one's a premium bond. All the groups get okay with this problem? Did you have any trouble with this one? It should have looked familiar from earlier chapters. It's been a while since we've done them, but it's just payments in the future, a future value as well, calculating a present value. Okay, I'm going to put you back in the rooms, and I want you to do problems 3 and 4. Nothing hard about problems 3 or 4, except there's some language attached to bonds. So for number 3, it says these bonds currently sell for 105% of par value. What does that mean? Casey, how do you interpret that?
That they're sold at a premium.
Okay.
I don't know.
Okay, they're selling at a premium. Bruce, what else do you know? They're selling at 105% of par.
I would also say it's at a premium, and the percentage would probably be less. So that's so it would be less than 5.9%.
Okay, and so what that 105% is telling you what the present value is today. So if it's selling at 105% of par, what does that mean the present value is today? What's that value? Raise your hand if you know anybody. That's the only hard thing about this problem is the language. Corey?
Is that $1,050?
Yeah. So the par value of a bond is 1,000. So if you multiply that by 105%, the price of the bond is actually 1,050. That was the only tricky part for number 3. So I'm going to put you back in your rooms and take a look at problem 3 and 4 and work those together. And then when you're done, come on back into the room, or I'll bring you back in a few minutes. Let's see. There you go.